Welcome to Alpha Recap, the daily wrap from stockalpha.ai. Juniper here with Allison, and we are back after the close to break down the tape. As always, if you have questions, you can reach us at stockalpha.ai.
Hey everybody! Allison here! We've got a lively one today. Markets closed mixed, but the real story was a cross-market shuffle where materials, energy, and tech led while consumer and health names felt the heat. Juniper, I loved the word you used in the note. Multidimensional. That's exactly how it felt.
Multidimensional is right. There wasn't a single shock driving everything. Instead, three durable themes collided: AI monetization and M&A in tech and communications, the energy transition and storage push, and a renewed focus on resource security that lifted miners and materials. Offsetting that were policy moves: Medicare Advantage risk score tightening and local resistance to data centers, plus some cannabis legal battles that weighed on healthcare, parts of consumer retail, and certain real estate pockets.
Let's hit the big highlights first. Tech got a boost from ad experiments and deal flow. OpenAI started testing ads inside ChatGPT, and there were sensor and AI infrastructure deals. Energy rallied on big corporate clean power buys and better US LNG margins. Materials popped after uranium and aluminum approvals and rumors about De Beers ownership talks. That's a mouthful, Juniper. Where do you want to start?
Start with what moves markets most: revenue hooks. OpenAI's ad test mattered because it signals how generative AI can be monetized. If ads work inside a chat product that opens a high-margin revenue channel and it ripples through ad tech, cloud providers, and data center demand. But there are trade-offs: user retention, moderation, and regulatory attention.
Totally. For listeners who don't live in ad tech, think of it simply. Platforms that people use for AI could start charging advertisers a lot more, and that money flows into companies that host and support those models. It's like adding a new highway for revenue.
Exactly. And the monetization experiments weren't the only tech headline. There was active MA in sensors and consolidation in parts of the supply chain, which helped a range of technology and communication stocks today.
Switching gears to energy. A 1 gigawatt solar power purchase agreement between Total Energies and Alphabet grabbed headlines. 1 gigawatt is a big corporate offtake. It shows enterprise buyers are scaling procurement. That kind of deal supports developers, utilities, and materials used in transmission and panels.
And complementing that, a U.S. home storage startup raised about $232 million, and there were battery safety tests completed. Those moves make storage less niche and more core to grid planning. Regulators and permitting issues still create volatility, but the trend is toward faster build cycles.
Materials had a day, too. There were environmental permits cleared for a Paraguayan uranium project, and reports that Angola is negotiating for a 20 to 30% stake in De Beers. Add aluminum approvals and rare earth activity, and you get a materials rally tied to resource security.
On the point of resource security, investors are starting to price in scarcity and geopolitical risk. When permit wins or ownership shifts happen, miners tied to nuclear fuel cycles, defense metals, and rare earths can re-rate. That's why the materials group outperformed today.
But not everything was sunshine and solar. Consumer and retail had headwinds. A couple of recognizable names filed for bankruptcy, while other retailers reported modest sales gains. One retailer posted about a 6% sales increase. The sector is bifurcating into omni-channel winners and legacy mall names that are crumbling.
Healthcare followed a similar pattern of policy pain. CMS announced moves to tighten Medicare Advantage risk scoring, which directly affects insurers with big exposure to that business. That tightened a near-term revenue and margin outlook for some payers and hospital systems.
Put simply, if the government reduces the risk score models used to pay insurers, insurers collect less for the same enrollees. That hit stocks because analysts have to rework forecasts. Until there's clarity, the sector will probably trade with a higher premium for policy risk.
Real estate was mixed. There was a $415 million refinancing and new construction loans that showed deal flow, but local opposition to data center builds and mortgage affordability at a 4-year high left the sector directionless. Some property types face execution risk even while refinancing windows help others.
That mortgage affordability point is interesting. Nearly 5 million borrowers have refi potential. That supports consumer liquidity and residential credit profiles, but at the same time, local fights over data centers and new lender rules add a layer of idiosyncratic risk for commercial real estate.
Let's talk crypto briefly because it was a key cross-sector theme. Bitcoin moved toward about $60,000 as outflows slowed, market maker flows accelerated, and miners sold coins to fund pivots into AI. Bernstein reiterated a bullish target of $150,000 for Bitcoin, which shows some research shops are very constructive. But this market is still sensitive to regulatory scrutiny and on-chain illicit activity.
Crypto's maturing in an institutional way. Custody solutions, tokenization, even the Fed talking about skinny master accounts. That helps liquidity and adoption, but it also means new rules could tighten things quickly. For investors, it's a story of expanding product sets with regulatory caveats.
Those caveats are really the cross-cutting risk today. From CMS changes in healthcare to local bans on data centers, cannabis legal fights, and EU scrutiny of platform AI, regulation was a theme that subtracted from the upside in several sectors.
Totally. So, how would you position your portfolio given all of this, Juniper?
If you're bullish on the energy transition, overweight utility-scale solar, storage, and transmission materials, favor developers with secured power purchase agreements and vendors that clear safety tests. Watch permitting timelines and PPA pricing closely. For resource security, favor miners tied to uranium, rare earths, and strategic metals, especially mid-caps that just cleared environmental reviews. Monitor geopolitical developments like the Angola De Beers reports and any export control moves.
If you're trading AI and tech monetization, go after platforms and infrastructure that can capture ad dollars and enterprise AI spend. Cloud providers, ad tech, GPU, and networking suppliers. But keep an eye on monetization rollouts and antitrust probes, because regulatory headlines can sting quickly.
On the cautious side, trim exposure to mall-centric and heavily leveraged retailers. Favor omni-channel winners and retail tech providers that improve margins and inventory turns. For fixed income and real assets investors, the refinancing window is an opportunity, but be selective. Data centers and logistics face local pushback, while residential looks more stable.
And for crypto and fintech fans, keep a selective exposure to traded crypto, where institutional custody and tokenization are expanding. Consider fintechs that provide custody and settlement services. The key things to watch there are regulatory clarifications, custody approvals, and miner treasury behavior. Miners selling to fund strategy shifts is a fascinating dynamic, tying crypto into corporate finance.
Quick checklist of what to watch over the next 30 to 90 days: PPA announcements, project permitting, and battery safety test outcomes, OpenAI and other AI monetization rollouts, CMS guidance and insurer reserve updates, and commodity permit developments for uranium and rare earths. Also keep tabs on Bitcoin around the $60,000 level and any major regulatory moves on crypto custody.
Let me add some plain language takeaways for listeners. 1. The market rally we saw was concentrated. Energy, materials, and parts of tech got the lift. 2. Policy and local politics created real winners and losers. Health insurers and some real estate plays got clipped. And 3. Being theme-oriented helps, but you need to manage the risk that regulation or permitting delays can blow up concentrated bets.
Well said. A couple of short sentences to close. Markets closed mixed, driven by secular themes: AI monetization, the energy transition, and resource security, but also tempered by policy headlines. The smartest portfolios will combine thematic conviction with disciplined position sizing and hedges for regulatory shocks.
That's our recap. If you want to dig into a specific sector or a company we mentioned, head to stockalpha.ai and ask us. We'll answer through the Q&A feature. We'll also keep updating our watch lists there.
Thanks for listening. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly through our Q&A feature, and we'll answer live. For more market analysis and insights, visit stockalpha.ai. See you tomorrow after the close.